War will have its effect on the stock market. It is important to educate yourself on the dangers and the unforeseen circumstances, the potential threats. Join the Money Network and let's have a look at the facts. What's up everyone, my name is Joris and welcome to the Money Network. A shorter video this week because I'm in Egypt on an educational trip. The sound will probably be a little bit worse than otherwise, but let's go. I felt I had to talk about the current events. As you have undoubtedly heard in the news today, tensions between Russia and the Ukraine have resulted in a full-blown invasion. While this is without a doubt a huge problem and it will have enormous geopolitical consequences, it is not the topic of this video. I have no knowledge about the politics, so I will stay away from the topic. I do sincerely hope that the troubles will lay down soon and hope that everyone still remains safe. It is hallucinating what is happening right now and I cannot start to understand the weight on the society in Ukraine. This video, however, will handle about the investors' attitude towards uncertainty and war in the modern age. All through history, wars and major political events have had a major impact on the stock market. But on the plus side, in most cases, the equity markets were never pushed down on the long term. When we are looking to Europe and European investors, this time it might be different, however. In the past, LPL Financial Research noted that stocks often shrugged off the past geopolitical conflicts. Of course, the days of the actual events and the weeks and months after can have a negative tone, and the markets can go down during these periods. Eventually, the market will recover and the total drawdown will be recuperated. During the Second World War, from 1939 to late 1945, the Dow Jones went up by 50%, with an average annual return of 7% per year. The relationship between a geopolitical crisis and the market outcomes isn't as simple as it seems. This time, however, a potential full-out war between Russia, Ukraine and the NATO allies could have a more severe impact. These problems will mainly be translated to commodity prices. While the USA has learned to be less dependent on energy price swings during major events in the past, it can definitely be different this time around. Russia is a key producer of crude oil and natural gas, and it transfers a huge amount of it in Europe. If Russia then decides to shut down the spigot, this could lead to the continuation of the exponential growth in energy prices we have seen in recent months. Interruptions to the ports around the Black and the Baltic Sea could also create even bigger shipping issues, and it could lead to food inflations as grains and other staples remain stuck at the ports. Avoiding a rise in energy prices will be inevitable. It's important to create sustainable value. When you are investing in a global diversified stock portfolio, you can actually make sure that if one part of the world starts to get in major trouble, you're still shielded by other parts of the world. This week we saw just that. The Moscow Stock Exchange dropped by 50% in one day, while the European and the American Stock Exchange limited their losses to a few percent. Anyway, if you're looking at the current stock market and you're not sure what you should be doing, buying the dip could be a very good strategy now. But here, both selective and diversified investing comes into play. This includes focusing on qualitative stocks and very diversified funds. Because when stock markets panic during these sort of events, these geopolitical events, the whole market will go down. But of course, not the whole economy will be affected. Buying at these low points in time will boost the return of your investments. In short, stay invested, invest on fixed points in time, and maybe invest a little bit extra when markets dip. Thanks for watching and enjoy your time at the Money Network.